All right. Thank you for joining us, everyone. We're thrilled to have Grant Hensel here today with us from Entrepreneurial Capital, and I'll jump to his intro in just a moment. But you're joining us for our Friday speaker series where we invite a guest from across the ecosystem to chat about a topic on acquisitions. So we're thrilled to have Grant here with us today to chat about how raising capital is changing in 2026. My name's Liz McRae. I'm a co-founder of Village Wellth, and if you're new to us, we are a deal management platform that was built for buyers. And so what that means is we've got our software built to support the buying journey across finding deal flow. We have over 50,000 deals within our marketplace system now. We've built a deal management dashboard for you to track and monitor your activity across all the deals that you're evaluating, as it gets quite messy at times, and you can track everything from one dashboard. And then we've also built in AI analysis tools so that you can quickly analyze deals and understand if it's a pass or pursue moment for you with each deal. And we have deal structure calculator and analysis tools, as well as understanding if a deal is bankable from your personal means or your investment capital that you're injecting into the deal. So it's all built in within the platform. We partner with ETA accelerators, incubators, communities, lenders, investors, and brokers and M&A firms. So if you are anyone in these categories, please feel free to reach out and we can chat about working together. And if you haven't yet tried Village Wellth, we have a free 2-week trial that you can access from villagewellth.com. Watch the spelling, Wellth. And our monthly subscription provides you full access to the marketplace, daily notifications of new deals, weekly open office hours, and the full access to the software to manage your deals in-app. So please feel free to put in the comments where you're from. I'm going to briefly introduce Grant here today. The format of these sessions is discussion-based. So today, Grant doesn't have a presentation to share with us. We're going to jump right into Q&A. We recently did a session with Proc Search Capital, Adam Markley, and Peggy. And so we're going to send out in the recording, we'll also send out their presentation because they had done a foundational presentation when they came on a few weeks ago. So we'll send that out as well if anyone is new to raising capital and what investors are looking for. So that'll accompany this recording for this session today as well. And feel free to jump in and ask questions as you go. Don't leave the floor just to Grant and myself, and love to have the participation. So a little bit about Grant. Grant is the founder and general partner of Entrepreneurial Capital, a $12.8 million fund focused on investing in entrepreneurship through acquisition transactions. He's been a small business owner for the past 9 years, building and operating a company he founded that employs 60 people today. Grant and his wife have also acquired a business together, which she now runs as CEO, giving him hands-on experience across founding, acquiring, and scaling owner-operated businesses. So thank you for being here, Grant. I know your schedule is very busy and you get asked to do quite a few of these. So we really appreciate the time that you have to spend with us. And yeah, if you want to add anything to your bio that I didn't mention, we'd love to hear more about you.
The only other thing I'll add is that I've started businesses 10 times and 7 of them totally failed. But two got acquired in relatively small transactions, and one has done well, which is the business with 60 employees that we still own. So lots of stepping on landmines and learning things the hard way. And that was part of the desire to become an investor is I love helping and like being a support for people who are buying businesses and telling them about the dumb mistakes I've made and hopefully helping them avoid making, at least they can make different mistakes and we'll all learn together.
You learn more from failure than success, they say. So you've got some scars to prove it, which yeah, that's brings your it's where we get your expertise. That's fantastic. So I guess let's jump right in. There has been some shifts over the last few years in raising capital and the ecosystem. There are more funds now, more investors in the space in ETA, which is fantastic, but it also creates some nuances and some etiquette, which is now more formalizing. What's your perspective on how things have been evolving and shifting over the last few years, Grant?
It's definitely shifted a lot. As mentioned, there are more funds in the space. There's more awareness of the space and how it can be attractive. The SBA rules have changed dramatically in the US. And I think that the tide is starting to change. We've always thought that the SBA is just such a huge advantage to the US market and that it's more difficult maybe for people in other countries. I think that the pendulum is shifting for better or for worse, where the SBA is becoming an increasingly complex institution to work within. And I actually think that a lot of the skills that people outside the US are developing to get deals done are going to be things that people in the United States are going to have to learn from very soon, or or even right now. So it's definitely changed a lot. I think one of the things that's been most salient is that the days of, I'd say, more aggressive investment analysis or underwriting are behind us. And I think for very good reasons. Especially in the US, there were lots of deals that got done over the past 2 or 3 years where it would be 80% bank debt, 10% seller financing, 10% equity. And our view is that that is just a really, really aggressive way to buy a business, and that wherever possible, doing more as equity and doing more to put cash on the balance sheet at close is just essential. And that's what we heavily encourage all the searchers we work with. I've invested in all kinds of small business deals, and everyone wishes that they had more money on the balance sheet at close.
Oh,
And so we're
at
trying to
close.
pay that forward.
At close and also post-close as well, would you say? Is
Exactly. Yeah. Money at close to be put on the balance sheet for post close liquidity needs, because there are just problems. Like most people have probably heard of the J curve, where you'll experience difficulties in the first 12 to 18 months. All of those difficulties will cost money, and all of them will need cash, and they don't need profitability on your accounting statements. They need cash in the bank to deal with. And so uh, we strongly encourage people to put a lot of money on cash, in cash at close on the balance sheet, that just sits there and does nothing above and beyond a line of credit and other defense mechanisms.
can it also be, where you've got investors on your cap table where they've got more depth, or they would be willing in the event that that J curve happened and you needed to draw more, um, is a
Potentially, but I would say I wouldn't rely on that if I was in the shoes of a searcher. I would say that that's most attractive in the upside scenario where things are going really well and maybe you want to do an add-on acquisition. Then having deep-pocketed investors is a great idea. The it's better than nothing, certainly. In a downside scenario, you want people who already have skin in the game, who have maybe money that could be deployed, but it's just going to be dramatically harder to raise that money from them. It's going to be at dramatically worse terms because the business is just, if it's raising emergency capital, that means things have gone really poorly. And so if you could choose between a world where, let's say, the business is going to need an extra $500,000 of working capital to survive the J curve, your economics and your quality of life, frankly, if you raise that in advance and stick it on the balance sheet at close versus if you have to raise it in an emergency, is just night and day. And there's no guarantee that you will be able to raise it at all. Like the pitch of we're losing money and circling the drain and we need more to stay alive is just not a very attractive pitch,
pitch.
unfortunately.
Yeah,
And so, yeah. And banks care a lot about your own post-close liquidity because they know that you might be the one that has to put it in a downside scenario. And you're going to be probably best suited to convince yourself of that versus convincing other people. So it's just it's a common reality that I don't think people pay attention to enough. And it's just like you're making a bet where if you survive, it's going to be awesome. You're going to make millions of dollars and it's going to be wonderful and you're going to protect people's jobs and it's just going to be great. And the downside scenario is bad. And so we encourage people of like, don't worry about the upside scenario. The upside scenario takes care of itself and it's fantastic. Spend all your time worrying about the downside scenario and preparing for it.
absolutely. And do you find that investors are being more, tactful in giving this advice? And, now that there's been a period of time where we've seen, transactions close and then this J curve be the reality for many of them, are they you
I
steering
think
people toward this direction more?
I think many of them are. I think that there's an interesting dynamic where there's some people entering from a more venture capital world who are because venture capital has struggled. And so they're like, let's invest in this other asset class. And I'm not painting people with a broad brush, but sometimes there can be a tendency, if you come from a venture capital world, every ETA deal looks good because the businesses actually make money. And so you're like, this is great. Like, yeah, I'll invest in all this stuff. Everything is better than my average venture deal. And we think that is just risky. Like you want to, the question I would ask investors if you have them is like, tell me about a time where, tell me about the experiences you've had where investments have gone south, or tell me about businesses you've run that have gone south. You've had to do layoffs, you've had to do whatever, painful problems and turnarounds. Um, because again, the upside takes care of itself. You don't have to worry at all about the upside. And you just want to stack the deck in your favor to protect against the downside because there will most likely be some kind of downward curve. And the wonderful success stories are the people that survive that, and the painful failure stories, the people where that just drags them down.
Yeah, absolutely. And so what is a common mistake that you see a first-time searcher making when pitching to investors?
Couple things. The first is not being just radically transparent about the pluses and the minuses of the deal. I think people feel, and it makes sense that they want to put their best foot forward, and that's good. Like you have to make sure that investor understands the positives of the deal, certainly. But the other thing that investor is trying to figure out is if you are a good manager of risk, and if you're good at understanding and seeing risks and putting in ways to mitigate those risks. And so if you underemphasize the risks, that'll be viewed as a negative because everyone knows there always are going to be risks, and so the investor is trying to figure out are you figuring out what those risks are and are you mitigating them, or are you trying to hide them from yourself or me because you think like it's going to be great, and you're sort of selling the dream. You don't have to sell the dream in this asset class. You don't have to sell the dream of like it's going to be awesome. If you the dream you're trying to sell is this business is not going to go bankrupt and it'll hopefully stay the same at least and maybe be slightly better. Like that's the dream you're trying to sell. And the side that you can focus on is just how it's like it's pretty resilient. Like look, it's it would take some effort to kill this thing or it wouldn't. This thing's actually pretty easy to kill, but I'm doing X and Y and Z to protect against that. That is so credibility enhancing. Um, because the other thing is the investor is minority. They don't have control. And so they're trying to get a sense of are you someone that can be trusted when you have an information advantage? You know more about the deal than they do. And that will always be true. You will always know more about the business than they will. And so they're trying to figure out are you the type of person who shares the things that are kind of awkward or painful or squishy or need to be figured out? Or do you paint an overly rosy picture? Because that's probably what they'll expect to happen post close, and they don't want that either because they want to be helpful post close, and they're not going to know how to be helpful if it's always unicorns and rainbows, and then suddenly the business dies.
Totally crashing. Yeah. They want the realistic view from the searcher. And so I want to come back to a point you made about control because they're minority and so they don't have control, which is typically how it works in self-funded deals when there's a co-investment party, is that the searcher still has majority control, correct?
Correct.
And so they're driving the boat, they're driving the ship. How do investors, it's different from traditional search funds where the searcher is the minority versus them having the minority. How does that relationship shift, or what are some of the investor expectations from searchers who, we're putting our capital in, we know you have majority, you are driving the boat. How does that relationship change?
It's dramatically different from having a majority owner that's a board. Like you're not in a traditional search fund, you're reporting to a board, the board can fire you, the board can overrule your decisions, and the board is ultimately in charge. In self-funded search, you're not. There's like you are you are in charge. There's a list of things that require investor approval, which basically all pertain to changing the economic arrangement. So like if you wanted to issue new debt or equity or buy another business or sell the business or do a related party transaction, like hire your sister or something, all of those things will require investor approval. But any operational thing, in the US, the SBA says investors aren't allowed to have any influence over that. Like they're not allowed to have control. And it depends in other countries. But the typical approach for self-funded search is the searcher has operational control of the business. And so it makes investors care a lot about two things. One, are the incentives aligned? And typically that alignment happens through the searcher being paid a salary that's sort of sufficient to live on, but is not crazy high, frankly. And that everyone's aligned where most of the money will actually be made through distributions. And there's sort of a distribution waterfall. Um, and investor return of capital is prioritized in that distribution waterfall. Um, it also it just changes the interpersonal dynamic. Like for us, we ask people and they're willing to do, like, they send us email updates and then we do quarterly calls and we do ad hoc calls, which is just us sharing experience and perspective and trying to be helpful. But we don't call the shots. We can't, and we don't. And that makes it even more important for an investor to partner with people that they feel like they can really trust, because the searcher will hold a lot more power once the deal is closed than
And
the investor.
do you find that the searchers are reaching out for the mentorship after post close?
It totally depends, but yes, on average, or at least the people we invest in do. And we're kind of screening for that a little bit of like, I don't think I'm God's gift to business ownership. I've learned some things and I can be helpful, and there's some areas that I can't be as helpful. And so, um, our ideal searcher is someone who is quite self-sufficient, but also uses all the resources that they can to do as good a job as they can. And we're one of those resources. And it's good to it's free. Like we're like free consulting. Actually, during the deal, we're a bunch of free due diligence, effectively, with skin in the game. Because if we say like, ah, man, we don't like this, it's good feedback. It's free due diligence consulting on, we'll tell you why we don't like it, and then after the fact, we want you to be successful, and we'll support that process for free. So because our money's already in, we can't take it out even if we wanted to.
We're in this together. I was listening
So
to a podcast yesterday from someone who was in a traditional search fund and then the 2 years lapsed, and then they went to a self-funded search model. And they said it was really hard to listen to the advice of their investors when they were looking at deals, when they saw something that they really, really wanted or they thought was a really good deal, but then the pattern of feedback from the investors was all the same. And for them to go, no, I have to listen. Like, I brought these investors in to help me and be advisors for me, and this
yeah,
be
yeah,
tough,
yeah,
which could be hard
yeah.
for some people, I can see.
Well, it's tricky, and yeah, and I mean that's the nice thing about self-funded search is that you get to know potential investors over a longer period of time, and you get to pick, like, there won't be a situation where you really like an investor and they have to be in, but they don't like the deal, because you don't raise the money until you have the deal, which is nice because it guarantees that the only people that will invest will be people who like the deal and like you.
And like you, yeah, absolutely. Well, I see some more people rolling in. Apologies, everyone, for the connectivity issues today. But as I chatter here with Grant, please feel free to plug your own questions into the chat, and we can get to them as we go along here. Grant, has the equity splits in the investor economics been evolving or changing, or what are you seeing in terms of how the deals are getting structured with investors?
Self-funded search with SBA loans, at least, it's typically the two factors are a step up and a preferred return are the main things that are being negotiated. So step up is a really weird way to understand equity ownership, because it should be called a step down. But in normal, just to explain this briefly, and I know it's maybe old news for some people, let's say that you are buying a business that does $1 million of EBITDA for 4 times multiple, and let's just say that you are doing 15% of that as equity. So $600,000 is the total equity check off the $4 million purchase price. And let's just, in a hypothetical world, say that you are putting in half of that, or $300,000, and someone else, let's just say it's me, is also putting in $300,000. In a normal world, equity is ownership. And so we'd say we are 50-50 partners. You have put in 50%, I have put in 50%, we are partners. In SBA land, the searcher says, I'm not doing that because I am personally guaranteeing this loan. I spent like a long time and a lot of money to find this business. There's no universe in which you own 50% of it. Grant. Sorry. And I say that's okay because I can't go above a 20% threshold anyway. And so that's all right. And so we'll instead do a different equity calculation that says, okay, you, Grant, have put in 100 or you put in 300 out of a $4 million purchase price, which is 7.5%. And so we will take that 7.5 and we will multiply it by a step up, which is normally 2.5. Let's just say it's 2. So you, Grant, will own 15%, and I, the searcher, will own 85%. And the investor says, that's fine, but the deal is you have to take a salary, it has to be capped, or maybe it increases with inflation. And when you make distributions, they first have to go to returning my and ours, both of our 300 grands. It has to first go 100% to that and a preferred return of typically 10 to 12%. And then we'll do this 85-15 split. So I'm fine with you owning 85%. I just need to have a prioritized return of the money I'm investing. That's sort of the standard that's become increasingly, it's like market clearing terms. It actually works. People know about it. And then all you have to do is negotiate the step up in the preferred return. And that'll be based on the riskiness of the deal, how attractive of a multiple you're buying it for, et cetera. So that has become much more standardized and clean, which is great. Although that only works with SBA loans because there's this personal guarantee component and so forth. The other component, and I'll just explain this in case it's helpful for anyone. The other way to do it is independent sponsor terms, where in that universe, typically it tends to be a bigger business, tends to be less debt and more equity. So let's just say that you're buying a business that does $3 million of EBITDA for a 5x. So $15 million purchase price. And maybe you can get like half, let's just make the math easy. Let's say you can get half of that as debt. So $7.5 million of debt, and you need $7.5 million of equity. And hopefully there's like some seller rollover and seller note in here.
But
But
typically no SBA in this situation.
in this situation, there's probably no SBA because you need more than $5 million of debt, which is what the SBA will do. The pari passu thing is kind of like a mythical unicorn. Like every once in a while, yes, it does happen, but just not that often. There's only a few banks that do it and only in very specific circumstances. So you're probably looking at non-SBA debt, which actually there's plenty of options for. It's not the end of the world. It can be done, especially on bigger businesses. And because of some of the SBA stuff, we're increasingly trying to get it to work for smaller businesses too, just as an FYI. But in this universe, let's say, so you need $7.5 million of equity. And let's say you can do like 500 grand of that or whatever, or some amount. And so you need $7 million of outside money. That is tricky. You can't really say to those people, you're going to own 15% of this thing, because they're like, you got to be kidding me. And you might not even have a personal guarantee in this case. So instead, what happens is what's called independent sponsor terms, where ownership is based on the pro rata equity that people put in. So you own 5 out of, let's say 500 out of 7,500. So you own 6% of the equity, 6.666% of the equity from your equity contribution. And then you get what's called carry, which basically says after everyone's gotten their money back, you get 20% of all distributions after that, just because. This is the way funds work. Like this is actually how my economics work with my investors. So you get carry. So basically you end up having like a 26% economic ownership in this thing, and you only put up 6% of the money. So you're pretty happy about that. You also typically get a transaction fee, which is often rolled as equity, which is normally like 2 or 3% of the deal value. So maybe that gives you another like maybe another 5 or 6% of equity. It's typically rolled in, and then you
And
get a management fee
is that transaction fee at the onset or at exit?
on the onset. So it would say like, we bought this thing for 15 million bucks. I'm taking a 2% transaction fee, so 300 grand. I'm going to roll that in. So we're just going to give me equity in addition, as if I'd put in another $300,000 of cash, would be sort of a classic approach. And then you get a management fee, slash salary, depending on how it's rolling. And like, if you're sort of the operating CEO person. So yes, so those are independent sponsor terms, which are very different from self-fund search terms. And we probably don't even have to talk. Traditional search terms are you raise money, you buy a business, you get 8% of the equity at close, 8% over time, and 8% based on IRR hurdles. So in a happy world, you own 20%, 24% at the end. You probably take a below market salary during the process, and hopefully it's good at the end. It's
How do
those are,
you?
yeah, three models.
Those are the three. I know this is where I feel like, maybe we should have had a diagram describing these three different ones. So there's lots of other podcasts on these models too. If you're hearing them for the first time, and independent sponsors becoming more of a formalized uh, structure, getting some terminology around it anyway. But I always find that, when new searchers are just finding out about these kind of vehicles, these pathways, and they sometimes struggle to determine, which one is best for me. What do you find kind of differentiates one searcher from another when they're trying to pick their pathway?
Yeah. So it depends. The first question is, do you want to go the traditional search route, which is most of the time is only open to you if you're going to like an elite MBA program or have just had an incredibly successful career that makes you then want to do this or like have really deep connections to traditional search investors. So I'll basically ignore that as a path for the purposes of this question. I also think it's the least attractive of the paths, but I'm biased. So pick your poison. Um, the question then between like self-funded versus independent sponsor is really just going to come down to how big is the deal, how much equity can you put in yourself, and how much will you need to raise, and what kind of debt will you need to get. If you're in the US and you can get SBA debt, you're probably going to lean towards self-funded search economics. If it's a bigger deal or you're not in the US, you're probably going to lean toward independent sponsor economics. Um, and and so that's it. Like those are basically the choices: traditional search or no, in the US or no, or rather using SBA loan or no. um, if not a traditional searcher and using SBA, you're probably in self-funded search land. If not a traditional searcher and not using SBA, you're probably in independent sponsor land or some hybrid that's similar to it. And if you're a traditional searcher, you're already locked into those economics.
Would you say it can be also, related to your comfort level of like what size company you'd feel comfortable operating or how much capital you feel comfortable raising based on experience or learning curve?
Certainly. Yeah, certainly. SBA loans tend to be for smaller business acquisitions in the grand scheme of things. Um, and yeah, I think that that's a very smart thing for people. Like I'd say if you've never managed a team of people, like probably don't buy a company that has 100 people. Um, buy something smaller or try and get team management experience and then go out and try and buy something. Um, but yeah, and there's a big um, our advice to searchers would be understand all the models that exist and then just try and find a great business because the funding will take care of itself if you find a great business and you're a great fit for it. That's like not the part to worry about, in our opinion. Worry about finding a great business and getting it under LOI that you could run effectively, and then the world will conspire to figure out a way to get you the funding. Like good deals will be funded one way or another. Finding a good deal is the hard part.
That's a great way to put it and so simple. I feel like we should like that's a billboard. We've got a question here in the chat. How do I know what price range businesses I should target that I can realistically get funded for acquiring?
The factors to consider in that is one, how much equity can you invest personally? More will increase the size of the business you can credibly buy. Two is what is your experience level and what have you done in your professional life? If you've managed a small, like the best possible thing would be and we invested in a searcher who did this. Someone bought a business, they put him in as the CEO to run it. He tripled EBITDA and then he led the successful sale of that business to someone else. And now he has now bought his own business and he's doing it again, except this time as the owner. Like if you've done that, you can do anything. You can do anything you want. And he was doing it in the same industry. Um, if you have been like had a successful career in corporate or whatever, like that you're probably also in a reasonably good, not as good, but like reasonably good spot to buy a business, especially if there's some relation to what you're doing currently. And then the third thing, which is going back to the previous point, is just how good of a deal you get under LOI. If you get a really good deal, it like you could probably, this is crazy, but like let's say just to stretch your imagination, if someone if you found a business that did $10 million of EBITDA and you've somehow in some weird way convinced someone to sell it to you for like three times earnings and you're reasonably competent, you will be able to fund that, even though it's even though you need maybe 20 or $30 million of equity, the equity will materialize for that if it's a good business and it's big and it's cheap. So I wouldn't worry about that. I would just worry about finding a great deal, and the equity will take care of itself and the debt will take care of itself.
Good deals attract good capital. Question here from Hannah. Is the transaction fee sort like earned equity by leading diligence and closing deal? You and the searcher is not paying those $300,000 transaction fees.
Correct.
Sweet.
Yeah,
Sweat it.
correct. So this is in the independent sponsor model. It's basically like sweat equity. It's the everyone saying, "Hey, you found this. Thank you so much. That's awesome that you found it. You're just going to get equity for free because of that work."
Good question, Hannah. Jean-Louis is in the self-funded model where the searcher is coming in as the operator with sweat equity, approximately 30%, and putting in no capital with investors providing all the capital. How does the balance of control typically work? Who has the final say on major decisions, and how do you structure governance so the operator has enough autonomy to run the business while investors feel their capital is protected?
Depends on whether you're using an SBA loan or not, because if you are using an SBA loan, the investors, eh, unless they're signing the personal guarantee, they can't have operational control at all. Um, if you are not using an SBA loan, then there's all kinds of different approaches. Um, what you're describing here of basically having roughly 30% sweat equity, no capital at all, but I'm assuming that maybe you found the deal. Um, what you're basically describing is the independent sponsor model, actually. Like the numbers are a little bit different, but they sort of get you to that 30% world, with very little personal capital put in, or potentially none, although that's certainly more rare. In independent sponsor world, the governance is either a small board, like a three-person board where the sponsor controls two of the seats, or a slightly larger board, maybe five people, where it's two from the sponsor, two from investors, one independent, or sometimes it's three, or sometimes it's investor controlled, either two or three, and either one or two from the sponsor. And all of that is just based on negotiation. And frankly, like a lot of it depends on how much skin you have in the game in terms of personal guarantee or personal equity commitment, or how good the deal is, just how effectively you can negotiate, because there's lots of equity providers that want to do it. And so people are willing to accept less stringent governance. That's all just ultimately negotiation.
Common negotiating points. Another question from Hannah here, do those 300K transaction fee paid by investors then get a step up as well as preferred? So we're talking about back to your example, I think where you had said $4 million purchase price, I believe.
Yes. Yeah. So good question. So, um, and maybe two concepts are getting confused, which I should have brought a diagram for this. Um, we in self-funded search land, in the example we use, the $1 million EBITDA, $4 million purchase price, the $300,000 that investors were putting in was not a transaction fee. It was just cash, which then receives a step up. The searcher in that example was also putting in 300 grand as cash, which also would receive a step up. So basically, the cap table for that would end up looking like, let's just pretend it's me, Grant Hensel, 15% as preferred stock, searcher 15% as preferred stock as well, and then searcher 70% common stock. So the searcher ends up owning 85% total between their preferred and their common equity ownership. In the independent sponsor world, which is where there was the transaction fee, investors are just putting in money, getting equity ownership, and the searcher sponsor is both putting in money and getting in equity ownership pro rata with that money, and they're also getting some additional ownership just because, called a transaction fee.
Hannah, does that answer your question?
Mostly. If I
Hit me with
would
the follow up though. It's confusing. Yeah.
Okay, Grant, perfect. Thank you. I understand the 15, 15, and 70 preferred and common. What I am confused about is there is transaction fee in terms of like QV or lawyer fee. Let's say it's 300K. Like if the investor pay for those, how do they get compensated? And do they get transferred towards equity in any way?
Yeah, good question. So most commonly in self-funded search, the searcher pays for those transaction fees. People need to come up with better names for this because it all is used the same name to describe completely different things. But like the searcher typically pays for things like the QV, and that is not reimbursed and does not become equity, but it's considered reasonable because the searcher is getting 70% of the equity in this case for free. Or not really for free. They're getting it for signing the personal guarantee, for paying for things like the QV out of pocket, etc. In independent sponsor land, the searcher and or investors are also typically paying for these transaction costs, but they're typically reimbursed at close for whatever their expenditure was, or they're rolled in as equity, pretending that that had been invested as equity. And it ends up being effectively the same. Um, but yes, very different, weirdly, for searchers versus independent sponsors. And it's basically just because it's reasonable for a person who paid for something to be then paid back for it when the deal closes, unless that person is getting 70% of the equity for free, in which case it's like, let's call it a wash.
Perfect. Thank you.
Yeah, great question.
We've got one here from Vic, and it's a great question here. For larger deals, the brokers may want to see proof of funds. I can certainly provide mine, but what do you do when you need investors involved in your deal? So there's a couple parts to this question, so I'm going to ask them one at a time.
Yes, we are happy to provide proof of funds letters, and we recommend that people go around and get those. Or sorry, two things: support letters, which we're happy to provide. We have a wonderful person on our team named Peter, who's our chief of staff, who talks to pre-LOI searchers all day, every day, and so we'd be happy to be helpful to this. We can put Peter's contact info in the chat. The way we do it is Peter talks to people. If it seems like this is a person that we'd be excited about supporting, we give them a non-binding but support letter that they can show to brokers and so forth. And then we're also willing to do proof of funds where we can just send them like, here's a screenshot of our bank account, if that's the thing a broker's asking for. Um, More than happy to do it. And we only do it for people that we've given a support letter to, because otherwise it's sort of disingenuous.
Thank you. And then, so Vic's second part of the question is, when do you want to get brought in? Before EOI stage or just before the LOI or after LOI?
We're happy to chat. Like we love for people, even pre-LOI, to chat with Peter on our team. We actually have all kinds of resources that are all free for pre-LOI searchers, including support letters, but also a bunch of other stuff. So we want to be helpful. We want to be helpful at any stage in the process. And yeah, Peter like gives people gut checks on deals all the time. They're like, hey, I'm thinking about this, I'm thinking about this purchase price and these terms. Like, how would you guys think about that? He can give sort of quick senses of just like how it might work. So we're happy to do it, and yeah, thrilled to be helpful.
Thank you. And number three for Vic was, do you invest in Canadian deals?
We do. We haven't yet, but we would like to, and our fund documents allow us to. And so, if anyone has an attractive Canadian deal, we are thrilled to take a look at it.
I guess we didn't really chat about your parameters. What is your kind of investment box? What's your
Our
thesis?
sweet spot is at least $750,000 of EBITDA, less than a 5 times multiple. And then the things that we care a lot about qualitatively are customer concentration. We want it to be low, capital efficiency, we want it to be high, and recession resistance, we want it to be high. So basic, and all of those things say like enduring businesses that are relatively difficult to kill from one big customer leaving, from someone slowing down payment and then that causing a cash crunch, or from a recession taking a bite out of the business.
Thank you. And both really important points from the lender's perspective as well, Bill. Um, what is like how do funds work together? So if someone's raising capital, do they need to go build a relationship with each fund, or can they build a relationship with you guys and then you guys would share it out amongst, if you took a piece of it, would you then share it with your network, and like how many relationships do folks need to build with their investor community?
Yeah, I would encourage people to um, have at least one strong investor relationship, because we basically on every deal, almost every deal that we've invested in, except for some really small ones, we've brought in our friends who are investors, and we're actually better positioned to do that than a searcher is, because we see like 250 deals a year. And so if we are investing in one and we say, hey, there's space on the cap table and we've done a bunch of deals together, other investor, do you want to take a look? That person always takes a look. And a lot of the time that person says, yeah, I'm in. And so you definitely want to have at least one that's like a pretty strong relationship. It doesn't hurt to introduce yourself to other people. It depends on the size of the fund. Like if you're smaller funds, unfortunately, aren't going to have as much time and like human capacity to give you a lot of attention pre-LOI. So it can just be more difficult to build relationships with them. But that's, that's totally fine. Um, Going back again though to the thing that we've maybe been harping on too much, and I know it's like sort of annoying to hear, is if you find a great deal, the investment will take care of itself. Because if you like, if let's say you bring to me a great deal, one, we will invest in it, and two, I will tell all my investor friends, and they will invest in it, and then you'll be locked and loaded. Um, so I would say yes, build a relationship with at least one investor, but just find a great deal. It'll be awesome.
Yeah, the most challenging part, finding the great deals.
Indeed. Yeah. Which is why Village Wealth and platforms like that are so helpful. So here we are.
Thank you. Do you have any bias between, broker deals or proprietary deals? What are you seeing?
No bias. I think the proprietary deal can be the mythical unicorn of great attractiveness. I think the tough part is that in practice, proprietary deals, which we sometimes see and sometimes invest in, either it's happening from like a very unsophisticated seller who's accepting a below market valuation for their business, or actually what we see often is that it's a pretty sophisticated seller who has accepted an offer that is probably on the high end of what would be achieved through a brokered process, because they said to the searcher or whoever got it under LOI, yeah, I'll go under LOI without doing a process, but you're just going to have to give me at the high end of the range because otherwise I'm going to go to a broker. And the buyer doesn't want that. And so they do give them on the high end of the range. So I don't think it's like this magical cornucopia of attractiveness for it to necessarily be proprietary. I think both things are worth trying, but I think broker deals get a lot of undeserved hate, and that there are all kinds of interesting ways. We've invested in all kinds of businesses that were brokered, but then the deal fell apart because someone's financing fell through. And so then the buyer we're investing in was like the second buyer that had been hanging around the hoop this whole time. And there's like a weird story like that. Um, almost every deal we invest in, there's a weird story of how it was found and how it was. And I don't think that's an accident. I think that's because the best deals, the answer wasn't just like, yeah, we did it, or like, oftentimes the searcher wasn't the first bidder or the highest bidder. They got chosen for other reasons. And that's great. That makes a great investment.
Yeah, absolutely. I know that all the stories of when the deals that actually landed and went all the way through, we've got some interesting stories of how they were found too. Um, so we've got a question here from Timotopy, and I hope I'm saying your name correctly, but more specifics around the types of businesses that you invest in, and maybe reframing this question from an industry perspective, if you have preference for industries or what you maybe are seeing a pattern in and commonalities.
Yeah, so I'll give this two ways. I'll say what we've invested in so far, and maybe that'll help give examples. And then we really think about it as what will we not invest in? And if it's not in the no category, it's maybe in the yes category. But to give some examples, we invest in a business that does tombstones, so tombstone sales and engraving for people who've passed away. We love how that is pretty recession resistant. Actually has great working capital dynamics because people prepay and it covers the raw material cost. And yeah, it's just quite resilient. It has sort of like local market capture where there can't really be two of them right on top of each other. We invested in an HVAC business, which is classic and has been great. And we invested in a business that does insulation refurbishment for manufacturing processes that are heat based. So that's interesting, but kind of like weird and boring and resilient and actually pretty capital efficient. So we like things like that. We don't like retail stores or things that are mostly actually real estate plays. So like car washes wouldn't really be a fit. The multiple tends to be high. It's basically like a form of real estate, and we're not real estate investors. Um, yeah, we steer away from overly techy things. Like if it's a software company or it's, like an AI platform, one, the multiple is probably going to be higher than five, and two, AI is just tricky to invest in these days because you don't know if the next turn of the wheel is going to destroy you or catapult you to the next level. So things like home services, things like light manufacturing, things like B2B services in general, tend to be good fits for us. But not retail, not e-commerce, not like natural resource extraction, and not things tied to volatile external factors like new home construction or things of that nature.
I like how you mentioned classic, like classic business instead of, lots of people call them, boring businesses, but I like framing it as classic. We have another one from Hannah. Thank you for all the great questions, Hannah. Um, how many investors do you normally prefer to see on the cap table along yourself? And then there's a part two question.
We don't have strong preferences. We don't want to be like one of, 10 or whatever, or 20. But if we're comfortable being the only one, we're comfortable being one of like two or three, comfortable being one of four or five, not a huge deal. Um, and then how much preferred equity is the maximum you'd like to see from the searcher at the cap table? No maximum. Yeah, you can do as much as you want. Every incremental dollar of searcher preferred, every incremental dollar that a searcher is putting into a deal makes the deal more attractive to an investor without limit.
Is there
There's
a minimum?
minimum, yeah, maybe the question was minimum. We'd say that if it depends on circumstances. Like maybe someone was in the military and that, just they don't pay the military that well. And so that reduces someone's, or they've been through a really long search process. Um, normally the minimum would be like 2.5% of the purchase price, unless it's a massive business, in which case less is okay. Um, but yeah, more is always better. And it's not like if you have a great deal and can't put in that much money, the deal will still get done. It'll just be a topic of conversation. Because what the investor's trying to, just to give you a sense, what the investor's trying to figure out is like, are you good at managing your own personal finances and good at saving? Because if you don't have any money to put in, maybe there's great reasons for that, or maybe like you're just not that good at making and keeping money. And the investor's trying to figure out, in this business, will you be good at making and keeping money?
Good, good question there. Okay, well, another one from Vic, and we've got about 8 minutes left until, so if you've got any lingering questions, feel free to throw them in right now, and I'll cut us off a few minutes before the end. But so from Vic here again, feel free to read along, Grant. Cap tables.
Yes. Yeah. So larger deals, say $1.5 million EBITDA, multiples above five, maybe 5.5 or six. Would you still not want to be part of it because your limit was five? We wouldn't say no without thinking about it, but the road to yes is much harder because $1.5 million of EBITDA is not that much in the grand scheme of things. And it would have to be just like a beautiful business that has a highly resilient, sustainable competitive advantage. We would say, okay, maybe this is interesting. Um, but if it's like, yeah, this is an HVAC business and we're buying it for six times off of $1.5 million of EBITDA, we'd just be like, unfortunately, we're not in that game. Like that's probably the right market price for that business, sadly, because people are bidding those things up, but we're just not going to be the ones participating in the market at that multiple, unfortunately.
So the classic, it depends.
The classic, it depends, but it probably is a no. Like to be, it's yeah, it's like 80-20, probably 80% of the time, no, 20% of the time, maybe, just to be transparent.
Another one here from Sarab. For boring businesses, would you want to see the searcher always have some kind of turnaround plan? And I think by boring doesn't always mean it's distressed or potentially needs a plan. I'm assuming. In other words, would you invest in a boring business that's just going well and selling at say 4 times EBITDA?
Every day of the week. That's exactly what we're looking for, is a boring business that's going well and selling at 4 times EBITDA. That's our sweet spot right there. And we don't, if someone's pitching that to us, we don't need to hear how they're going to double revenue. all we need to hear is how they're not going to let revenue fall and profitability fall. They're like, and they're gonna grow like 5% a year or whatever.
That's
That's
okay.
great. We're like so excited. Could not be more excited.
So they don't always have to have that grand ambitions of a high trajectory growth plan.
No, because we're gonna round it down to zero. We know that we hope that it happens, but it's not going to be part of the decision making process. Um, because we can't predict the future, you can't predict the future, and we know the upside takes care of itself. So we only care about the downside, which is weird. It's a weird, different, it's like the opposite of venture capital investing.
Absolutely. Okay, here's one from Raj, and this might be one of our last ones, but looking at a business that has achieved unusually high EBITDA in the last year, should valuation be averaged, in your opinion, from the previous years or just the high EBITDA as preferred by the owner? We see this all the time.
Yeah,
Trailing
totally.
12 months, I want.
Yeah. You're like, this is awesome. Yeah. Yeah. It depends to me on the nature of the business. Like if it's a project-based business that had a big project last year, and so that spiked the EBITDA, but there's no reasonable expectation that there will be huge projects every year, then we'd say, yeah, we got to average this for sure. If it's like, no, we just have a bunch of recurring customer relationships and we've added a bunch of new customers and they're still here. And so we definitely expect the future to mimic that, then I think trailing 12 months is, they're probably going to stick you to that, and that's okay. So that's the question we're ultimately asking is like, what period of time is a reasonable predictor of the business's future? Is it the last 12 months? Is it the last 2 years, 3 years averaged? That's the question you're trying to answer. And that's a good way to have the conversation with the seller. Because if the seller says, I want a multiple based on just last year's crazy high number, you can say, fine. So you're saying that you're very confident that the last year's crazy high number will be repeated. And the seller say, yes, I am. And then you say, perfect. We'll structure that as an earnout because you're so confident and I don't know. And that's great.
Hannah's trying to squeeze one more last one in, and I think we can probably do it if it's quick. What's the target hold period, exit time for your fund? Great
We're a
question.
10-year fund. We ask for a put right at year 7, where we can ask you to buy us out, basically, but we have a 10-year horizon.
Okay, fantastic. Um, Good source to find businesses willing to sell. Well, Village Wealth is one.
Village Wealth, I think. Yeah, is a great one.
Any others that you'd like to recommend?
Um, they're good. I mean, I I would just look at everything. Like I would make a list of all the places where businesses that you are interested in could possibly be listed, and I would check all of them over and over again every day,
You never know.
continuously.
You never know where
Yeah.
it's going to come from.
Yeah.
Well, thank you, Grant. We really appreciate your insight, and we'll be sure to get the recording out for everyone. My last question, are we in a buyer-friendly or an investor-friendly environment right now?
Um, I would have said it was pretty neutral 2 weeks ago. The SBA has been making changes that are in the process of getting understood that are making it significantly more difficult for investors to participate in SBA transactions. And I'm going to post more about this on LinkedIn, hopefully next week. So stay tuned as we're wrapping our minds around it.
Follow Grant on LinkedIn.
Yeah, that will create complexity where there will go from being like a lot of buyers and actually a good number of investors to the same number of buyers and less investors for SBA transactions in particular. I think it'll actually be a positive for non-SBA transactions because those people are going to have to do something else, which is going to be non-SBA. And I think it'll lead to people figuring out, and we're already working on this non-SBA debt sources, even for smaller deals, even in the United States. So I think it's actually a good thing for the world in general, weirdly, because it'll create less buyer competition between buyers. It'll favor though more sophisticated, like more established buyers. So pluses and minuses, but we shall see. It's definitely in flux.
Well, we've got some sessions coming up that feed into that topic quite well. We've got Grant Ferguson with Jumpstart Capital. He's coming in next week with some non-SBA debt solutions, and New Tech Bank is coming in soon as well on a session, and they also have non-SBA lending solutions as well. So stay tuned. Follow us for more sessions in the future for our Friday speaker series. And thank you so much, Grant. And what's the best way for people to reach, I guess, Peter? I know you,
Peter, yeah. Let me
but
just put Peter's email in the chat. LinkedIn is the best for me. And then Peter's email is just peter.vaselkiv@entrepreneurialcapital.com, and we will put it in the chat.
Perfect. Thank you so much, Grant. And again, hopefully we will work out our registration and login kinks, everyone. So thank you for your patience as we work through that. And everyone, we will release you to enjoy your Friday afternoon and have a great weekend.
Thanks, everyone. Take care.
Thanks, Grant.